Cool. All right. Well, whether you are in on the Zoom link or on Instagram Live, thanks for joining us today. This is maybe our fifth or sixth installment of Hard Money Isn't Hard. I'm with Capital Fund One, one of the managing partners here, Senior Vice President of Sales and Marketing. And the topic we're going to go over today is the BRRRR strategy, which those of you who probably follow some real estate investment influencers or have some sort of coach, or maybe you already implement this type of strategy, you're probably familiar with it. But the BRRRR strategy is a great way to build wealth through building up a real estate rental portfolio. And we see quite a few of our borrowers using hard money in order to execute on this strategy. So we'll go in a little bit, to this table of contents real quick. We're going to talk about Capital Fund just briefly. I want to keep this webinar more general on just how hard money in general can help you in this strategy. But obviously, I work here at Capital Fund. I think we do it the best. So we'll go a little bit into how we can help you. And then we'll dive a little deeper into the BRRRR strategy, the benefits of how you can combine the two, and then a quick summary. So Capital Fund got started back in 2009 here in Phoenix, Arizona. We started just managing about $2 million of assets. And over the last 11 or 12 years, we've grown to a portfolio of a little over 400 million. And all we do here at Capital Fund is lend money to real estate investors. So we don't wholesale, we don't buy properties. We strictly lend hard money, asset-based loans to real estate investors such as yourselves. We specialize in short-term bridge loans. That can be on something as simple as a rental, like we're going through today, a fix and flip, major renovation, ground up construction. We also do multifamily, commercial, land development. So we run the gamut in terms of our loan menu, and we'll go into it briefly on the different types of loans that we offer. But primarily, we're in the single family and multifamily space, which plays nicely into the BRRRR strategy. So for you to understand how hard money can play into this strategy and why it's widely utilized, it's important for you to understand the difference between hard money and a traditional loan. I'm going to start with hard money because it's the simplest. So hard money loans don't require a minimum FICO, most hard money loans. And one thing I do want to just preface is that when you're talking to a hard money lender, you do want to see what their underwriting guidelines look like. Here at Capital Fund One, we are purely an asset-based lender, meaning we're not going to look at the creditworthiness of the borrower whatsoever. So that's the context of a hard money loan that I'm talking about. So our hard money loans don't require any FICO scores. There's no invasive cash flow analysis. We're not looking at pay stubs. We're not looking at tax returns. We're not digging into the last 3 years of your financials. So that's what's known as a single track underwriting system of the property, not the borrower. Because we're looking at the value of the asset itself and not necessarily the credit of the borrower, we have to be very knowledgeable in the real estate markets that we're in. We do consider ourselves real estate experts here at Capital Fund. I'd suggest that any hard money lender you work with also be the same. But because we are confident in our valuation processes of real estate, we can look at the future value, not just the current value of each asset. And the reason that that's important to understand is because when you're talking to a traditional lender, where we can lend up to 75% of the future value because we're confident in our future valuations, a traditional lender is going to require a third-party appraisal. Oftentimes, they're just looking at the current value of the property. So if your plan is to renovate, which is a big part of the BRRRR strategy to renovate the property, you're not going to get credit for that future value if you go to a traditional lender versus if you went to a hard money lender. So you can actually get higher leverage, a higher loan amount using a hard money loan. So other disparities between a traditional and a hard money loan, like I mentioned, there's no FICO score requirement with hard money. There is obviously with a traditional lender. They are going to look at pay stubs, tax returns. They're going to want to see some cash flow there so that they know that you have the ability to service the debt and pay back the debt. So that's known as a dual track underwriting system. And it typically takes 30 to 45 days to close one of those, where with a hard money loan, ideally you can close in 24 to 48 hours. And then, as I mentioned, there's going to be probably a higher down payment with the traditional lender because they're only looking at the current value, not the future value. So as I've already mentioned, I want to keep this webinar more generalized because you may be watching this from anywhere in the country, and we're only in 3 states right now. So, but with that being said, Capital Fund offers hard money bridge loans, which is what we're talking about here today, primarily on single family or multifamily properties. We can go up to 90% loan to purchase price, and we do offer renovation funds as well, up to 85% of total costs. We do offer ground up construction loans up to 75% of total costs. We can finance soft costs, horizontal and vertical. We do offer land loans. We prefer to be in major metro areas if we are going to be offering a land loan, and we don't like parcels with entitlement risk. Commercial multifamily up to 80% loan to cost. We do offer hard money rental loans. These are up to 5 years, but not super competitive in my eyes, because you should be using us to acquire the property, refinance into something more long-term, something with a lower interest rate. And then we can facilitate what I call soft money rental loan, which we, in all transparency, wouldn't be funding, but we would pretty much be brokering these. It's basically a looser credit underwrite rental loan. So without further ado, let's get into the BRRRR strategy, which is what we all came here for. So BRRRR is just an acronym, and it just means buy, rehab, rent, refinance, repeat. This is a strategy to build wealth over time by building up a rental portfolio. To dive a little bit deeper into what this BRRRR timeline looks like and how a lot of our borrowers use hard money in order to execute on this strategy. First, you can use the hard money loan to purchase the property quickly. And this can't be understated, because oftentimes in this market, if you're going to find a property priced below market value, or sometimes even at market value, it's going to have to be an off-market deal. Or if it's on the MLS, if it's on the market, you're going to need to come in with a really competitive offer. Oftentimes, to come in with a really competitive offer, you're going to want to close with cash, or you're going to want to be able to close quickly with no appraisal contingencies, etc. That's oftentimes why people use hard money. The next R in the acronym is rehab. So you can either use your own cash, take advantage of the most acquisition funds using a hard money loan, and then use your own cash in order to rehab the property, or you can actually borrow the rehab dollars as well. And that's why I said we can lend up to either 90% of the purchase price, or we can do 85% loan to cost, including the rehab dollars. But part of this strategy is to improve the value of the property through renovation. The next R is rent. So put a tenant in place. And this is important, obviously, because you want to get some cash flow going on the property as quickly as possible. But also, when you go to refinance this loan into a traditional loan, those lenders are going to require to see an executed lease in place. Oftentimes, they're going to want some seasoning of a couple months. So put a renter in place, put a tenant in place. The second to last R is refinance. And now that you do have a tenant in place, go to a traditional lender. And then you've got 2 strategies when you get to this point. You can, if there's enough equity in the property, because remember, with a traditional lender, you're pretty much going to be capped out at 75% of the current value. So if there's enough equity to pull cash out of the property, so if we'll go into an example soon, but if your loan amount is 150, but there's enough equity for you to get a loan of, let's say, 200,000, you can either leave the equity in the property, which lowers your monthly payment to the bank, which helps the property cash flow more, or you can take out that extra equity, at $50,000 in equity, and roll it into your next property, which gets us to the final R in the BRRRR strategy, which is repeat. So you can use those funds to go into the next one. You can raise more money with your investors, or if you have some cash to move on to the next one, that would be the next step. So to go over a real deal, this is a loan that we funded this year with an exceptional borrower of ours, who I'm sure he wouldn't mind us using this as an example, but it was in Phoenix, Arizona. The purchase price was $179,000. We valued the current value when the property was purchased at $195,000. So we bought it at a $16,000 discount. His rehab budget was $40,000. We'll get in a little bit as to what improvements he made to the property. So our loan amount was $162,000 on a $179,000 purchase price. That's a 90% loan to purchase price loan amount. Our interest rate was 9.99%. The only fee associated with this loan from our end was a $999 loan fee. which our interest only monthly payment came out to $1,348, and this was a 6-month term. So this is a pretty typical deal, pretty typical terms that you can expect from Capital Fund One here in Arizona. So now, how did this play into this particular borrower's strategy? Well, he was able to purchase the property off market. I can assure you, he would not have gotten an opportunity to buy this property $16,000 below market value if he was not able to close very quickly, which again is how hard money plays into that. You come with a very competitive offer. So purchase the property for $179. Keep in mind, this is going to require an in-depth due diligence on your part. Run your own numbers, pull your own comps, make sure that don't rely on our valuations, rely on your own valuations as well. Make sure that you get your contractors in there, get a bid quickly, make sure you have your labor, your materials, everything in order so that you can move quickly on these types of properties. But bought the property for $179, loan amount was $162. So what type of cash requirement was involved in this transaction? Well, we had already mentioned there's a $999 doc fee, a down payment of $17,900, rehab budget of $40,000, closing fees. For a loan amount this size, purchase price this size, $3,000 is probably a decent estimate. I think our borrower actually came in with less closing costs than that, just because he's got some good relationships with title and escrow. And then if he was to hold this property, this loan for the full 6-month term, he would pay about $8,000 in interest only payments. So total invested on this property in terms of cash was just shy of $70,000, and we closed this one in 24 hours. Now, just for some contrast, if you had tried to use a traditional lender on this particular property, you would have expected to bring significantly more down. So a down payment of $44,750. And that's again, because we can use hard money lenders should be able to use a future valuation, not just the current valuation when determining their loan amount. So a significantly larger down payment if you're going to be using a traditional source of capital. And then everything else pretty much the same. The fees for a traditional loan is usually a little bit higher. It's usually about 2 points. I think that's a national average on a rental loan like this. So total invested from a cash standpoint, using a traditional source of capital is going to be about $95,000. That's in contrast to the $70,000 if you had used a hard money loan. Closing time again is about 4 to 6 weeks. So I mean, this isn't really even apples to apples, because this property isn't even an opportunity for this buyer if it takes them 4 to 6 weeks to close. It's only an opportunity for a buyer if they can close in 24 hours. All right, moving along. Rehab. So as we've mentioned a couple times, the budget was about $40,000. A couple things to keep in mind, or I guess a couple key questions that I think we got when surveying some borrowers in preparation for this webinar is, what do I need to make this house livable and functional as a rental? Well, as a rental, you have to keep in mind that it has to be a high enough quality to get a tenant in there. Let them be, you have to attract tenants. And then also you want to be thorough with your renovations and your repairs, so you're not sending somebody out there every night, every week to make repairs to the property. But you also don't want to over improve the property. I guess it depends on the strategy, but if you're in a more affordable price range, I wouldn't do too much, because there is going to be wear and tear on the property over the course of that lease, and that might be value you're not going to get back. What rehab decisions can I make that will add more value and maximize the price appreciation in the property? Well, considering the long-term key improvement decisions during this stage will help maximize the value you can extract from the property. So yeah, just keep in mind that depending on what your plan is for the property, is it a cash flow play where you're just trying to replace some income here, or are you planning to sell this property after owning it for 5 to 7 years and the market's appreciated quite a bit? So in this example, keep in mind again, $40,000 rehab budget. What did the borrower do? Well, they completely gutted the interior. That included covering up exterior wall material with drywall, new kitchen and layout, so knocked down some walls, new windows and doors, added a closet to reclassify office space as another bedroom, and then did a minimalist style landscaping to save on costs. Now, this is a very experienced borrower, very experienced investor. He has labor, materials, all that lined up. So if you're somebody who has those connections, you're a contractor, whatever the case may be, that might be what you can get done on a layout on in this price range for $40,000. But, you know, make sure you get multiple bids if this is one of your first projects. So after the rehab was done, you'll see here in this picture, there's, you know, not much that was really done to the exterior, just you know, just some small details there to get a tenant in there to attract it, you know, make it a little bit different than what the neighbor's offering. So this process to rent the property out, you can either do this yourself, you know, if you have the resources, if you're an agent, it really makes a lot of sense for you to manage your own properties, but you can get a property manager who can get a tenant in there real quick, especially in this market. If you did a decent job with the rehab, you should be able to get a tenant in there pretty quickly. Of course, they're going to charge a fee. In my experience, a property manager is going to charge about 10% of gross rent. If you don't have a good relationship with the property manager, it could be closer to 15%, just kind of depends. And it could be less if you do have a good relationship. Yeah, getting a tenant in the property is obviously an essential component of the strategy, because it not only provides cash flow, it allows you to profit off this endeavor in the end, but the quicker that you can get a tenant in there, the better, the faster you're going to be able to refinance this loan into something longer term, something with a lower interest rate. So in this particular property, the monthly expenses, so the monthly cash flow, if that is the strategy that you're going for, you'll see a monthly interest only payment. This is using keeping the hard money loan in place of $1,348. You've got some monthly taxes and insurance to pay, so $1,621 is your total cash outflow. And then your revenue, our borrower was able to rent this one out for $1,995. So monthly cash flow of $375, and that's with a hard money loan in place. So now getting to the refinance goes hand in hand with the next step, which is repeat. So refinancing is the final step in getting the money you put into this investment back out with the BRRRR method. And the BRRRR method is really designed, again, like we discussed, to build up the rental portfolio quickly. So in order to do that, what you're going to want to do is, as I discussed before, if you can get a 75% loan to value traditional loan, and that exceeds what you currently owe on your hard money loan, well, you can pull that cash out. So in this example, looks like we have a, let me see here real quick, I'm missing something. So this borrower was able to get a 30-year fixed loan, 75% of current value. Monthly payment for P&I came out to $1,396. I do believe that included taxes and insurance as well. Here we go, that's what I was looking for. So $291,000 loan amount. And if you do remember, our loan amount on this initially was, I believe, 162, somewhere in there. So there was lots of equity on this deal. I mean, this is a phenomenal deal with a phenomenal borrower who has a huge network to find properties at a steep discount. So this is, you know, this is a significant amount of equity that the borrower added to this property. So they had a loan amount of 291, which gave him $127,000 of proceeds to pull out of that property, roll into the next deal. And repeat. Final step of the BRRRR process, now that we've actually gone through the hard part, is now that you've gotten the cash, you know, out of the property, you've got a tenant in place, it's cash flowing. So, you know, monthly, the property value keeps increasing. The monthly rent is covering all the monthly expenses, and you've gotten the refinance in place. You'll start turning a profit, probably a small profit if your goal in this BRRRR strategy is to grow your real estate portfolio as quickly as possible. Don't expect to be, you know, netting $1,500, $2,000 a month on any individual property. This is more of an appreciation play. And over time, that cash flow will widen, that margin will widen. Now, the other alternative, obviously, is to not pull cash out when you get that refinance loan. Keep the equity in the property. You won't be able to scale as quickly, but you know, that does allow you to potentially net $500 to $1,000 a month on a property. And over the next couple of years, if you put 10 properties, you know, in place, you could replace the income that you're currently making at your job, if that's your goal. So in this property, the borrower profited about $157,000. took out $59,000 for the next deal. So left $97,000 of equity in the property, and monthly cash flow, the margin's about $315. So I misspoke in the slide before this when I said that they pulled 127,750 out. Looks like of that $127,000 of equity that the borrower had, they only pulled out 60,000, and so they left some equity in on the property. So benefits of hard money and the BRRRR strategy. I think I've hit it pretty well, that a large part of the real estate game today and investing in real estate comes from the buy. Are you making a competitive offer in order to obtain a property below market value? It's extremely important, especially if you're looking at a good rental area. You're going to have a lot of competition. There's lots of investors looking to do the same thing. So hard money allows you to close quickly, get those competitive offers. You can close on a timeline. There's no appraisal contingency. There's no inspection contingency. Obviously, that's up to you and the seller if you're going to put one in there, but the bank doesn't require one. And in comparison, if you're going to use traditional financing, you've got a 4 to 6 week closing time, probably minimum, especially on a rental property. Second benefit is less capital, because the alternative to hard money and the alternative to traditional financing is to use cash, right? Well, if you're using cash to buy a property, then you're probably you're definitely not maximizing the yields that you could be getting on that property if you had leveraged your money. And if you're risk adverse and you don't want a lot of debt, that's totally up to you. And I would just suggest that you don't need to finance this thing at maximum leverage. You don't need a 90% loan to purchase price loan in order to boost your yields a little bit. If you have the cash to close, but you want to be able to take down 2 properties instead of 1, then put a 50% loan to purchase price loan on both of those properties. Help you expedite the BRRRR strategy a little bit there. Portfolio growth, like we had mentioned in this BRRRR strategy, the final R in the acronym is to repeat. And when you refinance after you get a tenant in place and you pull the equity out with the cash out refinance, just roll it on to the next one. So now, we have to, since we carved out some time to teach you all about the BRRRR strategy, I got to pitch you on Capital Fund a little bit. Right now, we're in Arizona, Texas, and Colorado. Like I mentioned, we can fund in 24 hours. The reason we can do that and most people can't is because we're very well capitalized. We have not missed a closing due to a lack of financing in the 12 years that we've been here. We also have all in-house underwriters. We do not require a third-party appraisal. We don't outsource any of that, and we can turn around those quotes, those commitments in less than, usually in a few hours. Especially if this does have a closing date of the next day, we can hit that closing date. And then one-to-one service. So although we're large now, we're funding anywhere between $80 to $100 million in loans a month. We're scaling up our personnel, our staff, so that we can provide that same level of service to you, especially on the front end when you need some assurances of whether or not we can commit our dollars to your project. We're there. We're going to always answer your call, answer your emails, and get you those loan commitments to close on time. Let's see here. All right. So in addition to just our product, which is our, obviously access to capital, we have very competitive pricing in the hard money industry. We've also made a commitment to the real estate community by developing an internal software that we have now made frontward facing, so all of you have access to it. So if you do go onto our website, which I'm sure if you've signed up for this, you'll be getting a follow-up email that has that link in there. Otherwise, it's just www.capitalfund1.com. Look for the investor toolbox tab, and what that's gonna allow you to do is set up an account where you could actually use that portal to submit loan requests, but you can also use it to comp properties. Right now, we only have the data feed set up for Colorado and Arizona, but we will have Texas shortly, and any other market that we enter, we're going to add those data feeds so that you can go in there and you can comp those properties using our proprietary technology. And there are instructional videos on the website as well. So if you have any issues, reach out to one of us. We can give you some more information. We do also have a frequent borrower rewards program. So every 5th loan that you fund with us, you get $1,000 off the doc fee and 8.99% interest rate. and you'll be our favorite borrower. Partnerships with Capital Fund, we do have a good relationship with Home Depot, and we do pass those savings on to you guys. So reach out to one of our loan officers to get a key tag for Home Depot, take advantage of some good discounts on their products. Some highlights there: 20% off paint, stains, appliances at 6% above cost, special pricing on bulk orders, access to the bid room. I've personally seen a couple of our spec home builders really hit it out of the park with some lumber purchases, which, if any of you are purchasing lumber these days, know that it's not cheap. So take advantage of our relationship, with our size of our relationship with Home Depot. And then, as I mentioned, we do have a rewards program. So if you're out there building up your rental portfolio with the BRRRR strategy, and you're closing on 2 or 3 of these deals a month, you really can save quite a bit of money. We'll knock that doc fee off by $1,000 and give you a significantly lower interest rate. So that's the incentive to keep coming back to us. So Q&A time. These were sent in prior to today. So just again, like through a survey. So my question is that with hard money, do you provide rehab money? The answer is yes. So we can provide rehab dollars. So we can do just an acquisition only loan where we're just funding dollars at close of escrow to help you acquire the property. We can also do a rehab loan where we will probably fund a little less at closing, but then we'll hold back funds, and we could go up to 100% of your rehab budget. So with a blended loan to cost of 85%, if you want to walk through some scenarios, just reach out to a loan officer. It's really simple to explain. Do I have to install monthly payments with you, or do I pay everything after I get cash out refinance? So we do require monthly payments. We're set up as a fund. We have investors. Our investors require monthly disbursements. And so we collect monthly payments. Plus, it's a good way for us to check in on you in the project. If you stop making your payments, then we want to see what's going on. So we do require monthly payments. In addition, when I do a cash out refinance with local banks, do they use debt to income and verify income with tax returns? So there will definitely be an element of that to it. This strategy, the BRRRR strategy, if you're going to be refinancing into a long-term rental loan, does require you to have a minimum standard, for your credit worthiness. I would suggest, before you get into this, is just sit down with your local bank and ask them for a scenario. Have them pull your credit, have them take a look at your tax returns, and say, hey, if I've got a property that I can rent out for $2,500 a month, and my monthly payment to you is only $1,600, do you give me some leeway there for a lower credit score, or maybe the fact that you have some seasoning on this property? There's some looser guidelines for your tax returns or your pay stubs. I mean, they'll work with you if they're a local bank. If it's a national bank, they're going to be a little less flexible. So if I use a hard money loan, but would like to refinance at a lower rate, how would that process work via an LLC? I mean, it's going to be a rental loan when you go and you refinance it with a traditional bank. So sometimes banks will require it to be an LLC. From our standpoint, with a hard money loan, you can take out that loan as an individual, as an LLC. We don't have any restrictions. It doesn't matter to us. Again, we're looking at the property, not so much you. And you're going to be signing documents stating that you're not going to be living in that property. That's the only thing that we're concerned about. We don't even source down payment, to be honest. So we're not concerned with that. But obviously, the traditional loan that's going to be taking us out, they might have some restrictions there, but for the most part, if it's an LLC, that's okay. Tips on how to make sure we don't get stuck in a hard money loan where we cannot refinance to a long-term loan. That's going to be 100% up to you preparing for that takeout loan prior to beginning this endeavor. Prior to you going and making an offer on a property, it's real easy. There's a million loan officers out there that work for traditional banks. Call one, send them your tax returns, ask them what the process looks like to get approved for a rental loan, a refinance loan. There's no perfect answer there. There are other options though too, other than going to a Wells Fargo or a Quicken Loans. There are, what I mentioned before earlier in this deck, is a soft money products. And what that means is it's basically, it's a private loan. It's not quite as easy to get as a hard money loan. Like with Capital Fund One, we can help you facilitate those. We can introduce you to some people, broker those loans for you. It usually comes with a minimum FICO score, probably somewhere around 600, 620. They will require a third-party appraisal. And really that's it. There'll probably be a cash flow analysis to make sure that you're able to cover your debt service. Reach out to us. We can introduce you to those people. It's got some looser guidelines. They're not going to dig into your tax returns, not going to require pay stubs, but they do just have a couple more hurdles than we do. And that's going to be with an interest rate that's a little bit higher than a traditional loan, but not anywhere near 10% like we are. So thanks again for joining us. Hopefully this was helpful. Email any of the three guys here. I mean, we have a bunch of different loan officers. These guys are our core team. Zach heads up our sales team in Arizona. Sam heads up one of our teams out in Colorado. Jake heads up one of our teams out in Texas. They're happy to answer any questions that you have. We're always available either by email or by phone. And yeah, we'd love to be able to help you build up your rental portfolio, build some wealth, take advantage of this market, take advantage of this strategy, and do more deals. So thanks again. I think I'm gonna linger here for a little bit to see if we have got any questions. So it looks like we've gotten a couple. So tips for first-time flippers. Don't try to hit a home run on your first deal. Don't try to hit a home run on your 10th deal. Hit some singles, hit some doubles. Make sure that you're really, really comping these properties. If you don't have MLS access, find a friend who does, or go on Zillow. I mean, a lot of the market data on Zillow is accurate and it's current, but comp properties, only looked at closed comps. Don't look at, best case scenario, because there's a property a mile to the west of yours across two major streets and it's pending at, $300,000 more than what you're paying for yours. That's not a good comp. Pick an area with a lot of good closed comps that you can use to really determine what your current value of the property is and determine what an accurate future value of that property is. And pick something that doesn't require significant improvements. Pick something that's dated. Maybe you have to knock down a wall to open something up. I wouldn't suggest on your first flip doing anything that requires permits. I would suggest you go into your first couple of flips with low expectations of breaking even. Breaking even is the success in your first couple of flips. And then you can build from there. You can start to form relationships with your contractors. You can start to source cheaper materials, not cheaper in quality, but cheaper in price. That would be my suggestion to the first-time flippers. And then what areas in Texas are you lending in? So our solid focus in Texas right now is the DFW area. However, we've made quite a few loans in Houston. We're open to Austin. We're open to San Antonio. I think we've probably funded a couple deals in both of those cities. We've only been in Texas for the last 3 months, but we've been scaling up nicely. So if you're in the DFW area, stop by our office. That's where it is. But we're open to lending in any of the major metro areas in Texas. I'd say, really though, it's going to be in the DFW Metroplex. It's going to be the Houston area, San Antonio, and Austin. Right now, if you're in Corpus Christi, if you're some of these other tertiary markets, probably not going to go there quite yet. So yeah, I think those are the only questions we have right now. The slides and video of this presentation are going to be shared. And don't forget to follow us at Capital Fund One on Instagram, on TikTok, Facebook. Go to our website, check for new updates, sign up for the investor toolbox on the website. We've got promos up there. It's a great way to submit loan requests. You can take advantage of our rewards program. You must submit these loans through that portal if you want to take advantage of the rewards program. Otherwise, you won't get credit for funding a deal with us. And again, we want to be your resource in hard money. If you were listening to this anywhere in the nation, these same concepts apply. The numbers might just be a little different market to market. And that's just how hard money is. Arizona is a little bit cheaper for hard money than Colorado. Texas is somewhere in the middle. And then it ranges from California being probably the cheapest to, I don't even know what the most expensive one is, whatever it is, I want to go there next. But reach out, look forward to talking to some of you, and hopefully we can get some deals done. Thanks a lot.